council members, our mayor, our city treasurer, city attorney, chief of staff. Today is Monday, October 14, 2024. This is the City of Romulus City Council Special Meeting Study Session. This meeting is to discuss the quarterly investment report. Mr. Chair, roll call was taken at the previous study session. The roll call remains for this special meeting.
Okay.
The special meeting agenda is as follows. Number 1, roll call. 2, agenda. 3, discussion, the quarterly investment report. 4, public comment. Number 5 is adjournment. And a motion will be in order to accept tonight's special meeting agenda as presented.
So move to accept the special meeting agenda as presented. Support.
Been motion. Y'all can turn your mics on. Been motioned by Ms. Talley, supported by Ms. Abdo, to accept the study session agenda as presented. Ms. Talley?
Yes.
Ms. Abdo?
Yes.
Mr. Wadsworth? Yes. Ms. Roscoe?
Yes.
Chair votes yes, motion approved.
Thank you, City Council. We are now under discussion, and I will turn it over to our City Treasurer, Stacy Page.
Thank you so much and good evening, and thank you all for being here. It is greatly appreciated. And this evening, I do have Gray Lovely here from PFM Asset Management, and she's going to share the report with you for the quarter ending June 30th, 2024. Welcome, and thank you.
Great. Good morning, good evening, everyone. I've apparently not had enough coffee. Can everyone hear me okay?
Yes.
Okay, fantastic. So we are going to talk about June 30th report. So obviously we are past June 30th. We're well past June 30th. So I'm going to try to keep it a little bit more timely like I did last time I met with you. But at the same time, Stacy and I have had some side conversations about how to be a little bit more timely with getting this information to you as well. So we'll do that in the future. So first and foremost, there has been quite a bit that has happened in the markets since June 30th, but let's just kind of take a look at some of the things that we have here, and then again, I'll keep it more current for you. The first page that we have is really just a page that you're welcome to read, but I'm not going to read through it for you. I think you get pretty bored doing that. But the second page is what we call the City Surprise Index. It's not something that we look at on a regular basis necessarily when we're talking about economic data. But suffice it to say, if you look at everything in dark blue that's above that black line, basically all of 2023 into the beginning of 2024, we saw positive data. We saw things higher than expected, like inflation. The labor market was hotter than expected. It was tighter than expected, all of those things. And GDP growth also continued to be hotter than expected. What we saw during the second quarter, ended June 30th, really was a reversal of that, where we saw some cooling occurring in the markets in general. So the labor market started to cool a little bit. We saw inflation start to meaningfully come back down to close to where the Fed would like it to be. All of those things put together means that we've actually seen negative surprises during this period of time. The most recent period of time, if we think about this past quarter, June 30th through September 30th, we had kind of a mix of both. So there was some negativity when it came to some of the labor market reports that we saw, and we'll talk about that in a moment. And at the same time, we saw inflation coming down further, but then we also saw some surprises just the other day, for instance, about the labor market. So a little bit of a mixed bag there. When we talk about inflation, I think the most important thing that happened and has been happening over the past 6 months really has been what's going on with the Fed. There's been this question of will they, won't they start to cut rates from where they are right now? Really the answer is they are going to, they've started to. It was a question as to when they would and by how much. And they finally did start to cut rates in September. So they've cut rates now by 50 basis points, which is 0.5%, from the high where they were 5.25 to 5.50, now down to 4.75 to 5%. If you think about that in context of where we've been since the Great Recession, that is still quite high for the overnight rate, for overnight liquidity vehicles, bank deposits, money market funds, things of that nature. If you go down the street, you might see that you have pretty good rates at your local bank if you personally wanted to invest something for a period of time, but that has been coming down because the Fed has started to cut rates. And why has the Fed started to cut rates? It's because they didn't want to continue to put too much of a damper on demand in order to get inflation under control. They have a dual mandate to support full employment and also to have price stability here in the U.S. Price stability in terms of inflation not being too high or too low, and also full employment being, we don't know exactly what the definition is, but really as many people as can possibly be in the labor market at one time or another. So the reason I'm saying all of this is because during this period of time, we have seen inflation continue to come down as the Fed started to increase rates. As inflation has started to come down, many people were wondering, is the Fed going to wait until inflation hits their target of 2%, or are they going to cut rates earlier? And what ended up happening was they did in fact cut rates earlier than getting down to that 2% target. If I were to bring this closer to today, this is showing core. So core is a little bit different than regular headline inflation in that it takes out food and energy. Those tend to be more volatile components of inflation. If I were to take this closer to today, you'd see that blue line is now at 3.3%. The yellow line is even lower than that. So when we think about inflation, it does continue to come down, but it's unfortunately being buoyed right now by the fact that real estate and shelter prices are so expensive. So if you think about that, if you think about the fact that mortgage rates are so high, if you think about the fact that there's little inventory in terms of housing, all of that coalesces into shelter prices being high and keeping inflation somewhat buoyed. But if we flip the coin and talk about the other part of the Fed's mandate, which is jobs and the jobs report in general, when we put this together, you can see that we had seen the unemployment rate tick up to about 4.1%. It has since exceeded that and went to about 4.3% and now has gone back down the past 2 months, back down to 4.1% again. We did see a period of time where the amount of jobs added, which is in the left-hand corner there, the amount of jobs added to the economy was much lower than anticipated, much lower than it had been for all of 2023 and the beginning of 2024. And people were very concerned about us putting a damper, too much of a damper, on the labor market because rates are so high. This past report, though, from a week ago or so, actually reversed that. We saw 254,000 jobs added to the economy just during that month of September. So again, mixed bag there, but it doesn't appear as if we're going into some sort of a recession. It doesn't appear as if, things are falling off a cliff.
Through the chair.
Yes.
Just real quick,
Yes.
you talk about all these jobs being added.
Yes.
But is people working?
That's a great question.
Do we have a report that does it something that tells us? Do we talk about full employment?
Yes.
I don't know what that looks like either, and what that means. Because I'm sure we can't get there, or is there a goal or parameter to get to full employment?
Yeah,
Because
so-
that number, I don't see that being attainable.
That's interesting. So full employment does not mean 0% unemployment.
Okay.
Full employment has historically been defined as 5% unemployment or
Okay.
lower. Now, you could say, coming off the heels of 3.4% unemployment over the past year or two, that maybe 5% is not the right metric anymore. Maybe it's actually lower than that.
Okay.
But really what it has been has been quite a bit below that 5% target. So when you think about what Fed Chair Jay Powell has been saying in terms of employment and are we at full employment, where are we with all of that, he doesn't want to see any more cracks forming in the labor market, but at the same time he said he thinks that we're pretty much at full employment right now.
Okay. Thank you.
Yes, absolutely. Good question. And if anyone else has any other questions as I'm going through this, feel free to interject. I'm going to skip over this page for the sake of time, but this is just showing wage growth over time. There was a period of time where switching jobs was very lucrative because the quits rate was so high. Now that's not as lucrative. You can still get a better rate of return, if you will, on your supposed wages if you do switch jobs, but it's not as much of a lucrative choice as it was before. And this page really gives us an idea as to what is going on with the consumer. The reason I wanted to focus on the consumer is because the consumer drives the U.S. economy here in the U.S. So if you think about overall U.S. economic growth, GDP growth, that is made up, 70% of it or so is made up of how you and I go out and spend money. So if we're spending money, the economy is typically doing well. If we're not spending money, the reverse is obviously the case. On the right-hand side, you can see retail sales. This is what people are spending money on. Typically, this is mostly based on things, so goods that people are purchasing. You can see it continues to go up, but not at the same pace that it did during COVID. A lot of that has to do with the fact that fiscal stimulus has now been spent down. We have the CARES Act. We had another bill that was passed in December of 2020. We had ARPA funds, all of those things. That has all kind of gone away, at least from the household perspective. So let's jump into what's going on with the Fed. Again, this is old, so I will give you an update as to what the Fed has most recently been projecting. This is the Fed dot plot. It gives you a sense as to where the Fed thinks overnight rates will be by the end of each of these years. So when this was done in June, the Fed was expecting that we would still be at 5 to 5.25% by the end of the year. Well, that's clearly not the case. They've already taken rates down quite a bit. So now they're expecting rates are going to be actually down about 1% from that level. So when they put this together in September, which again is not shown here, they had a much different picture as to what they expected for the overall markets than they did when they put it together in June. And that's because of the fact that we started to see the labor market not crumble, but start to see some cracks in the labor market. As we move forward out the curve, you can see expectations are for rates to continue to come down, and then long-term to be around that 2.8, 2.9% range. Why this matters to you is because we are going to see rates, as they come down, you're going to see less and less interest earnings on your investments, okay? So especially on your overnight investments. Those overnight investments are tied to where the Fed is basically anchoring overnight rates. And as the Fed lowers that, you're going to see less and less interest earnings on those types of funds. I'll talk about how we're going to mitigate that in a second. Here are some other projections that the Fed puts out. Again, not too much interesting stuff to talk about here other than the fact that PCE inflation in the bottom left-hand corner there, yellow, was expected to continue to be above 2% even through the next few years. So again, Fed is targeting 2%, but they're acknowledging that they're probably not going to get back down to 2% meaningfully for the next few years still. Any questions before I start talking about actual investments?
No questions.
Okay. So this is the yield curve. This shows where treasuries were trading across the curve from overnight rates all the way up to 30 years. We are only investing out to about 5 years for you. So if you think about that, think about just the front part of that page, just the left-hand side there. Again, this is from 630, so you can see the line from 630 is that dark line. The blue shaded area is where rates have been in the past year, and so at 630, we were basically within the middle of that range. Fast forward to today, if I showed this to you today, you would see it's a very different picture. The 1 year range is much wider and much lower, and we are basically at or close to the bottom of that 1 year range. So to give you an example, a 2 year treasury, which at the time was yielding 475 when we put this together on 630, is now yielding something around a 360. So it's a very different picture from where it was. This is important for you because we've made some pretty significant changes in the portfolio over this quarter, and I think you'll be very happy with how that turned out. We don't try to time the market, it just happened to work out in our favor, and I'm glad that we did it when we did, and I'll get to that in a moment. The rest of this is just talking about different sectors that can be invested. Really, we're not looking at the right-hand side for you. Corporate notes are not permitted by Public Act 20 here in Michigan. Neither are asset-backed securities. The blue section on the left-hand side, federal agencies and federal agency mortgage-backed securities are permitted, and both of those are in your portfolio. So when we talk about actual returns for the quarter, you can see they're all positive here. Again, we're not talking about anything in orange, yellow, or pink. It's just blue and gray for you all, just from this page. But again, anything that we had in the portfolio that was different from treasuries was additive to performance. So when we look at actual performance, you'll see that it was quite positive. And then again, I'm going to skip over all of this and get to the account summary. Any questions before I get into the accounts themselves?
Any questions? No questions.
Okay. So what you can see here is bank deposits and investment securities. This information comes from us, but it also comes from Stacy. Stacy prepares a bunch of information and gives that to us so we can coalesce it into one report. You can see that 41% of your funds are in that under 6 month space. That's because you do have quite a bit of money invested in short-term funds. That being said, you can see now there's also money invested in that 3 to 5 year space. This was not really the case a few months ago. So this is a change that we have currently been making over the past 6 months or so, trying to make sure that we're able to mitigate some of that risk that as rates come down, you're not completely affected by that interest rate change and are able to lock in some of these longer term yields. Here's the split between the different types of investments. Credit quality, just one thing to notice here on this page, you might say, why do we have so much in AA plus credit quality? I'm not sure if I mentioned this last time I was here, but the Treasury Department, the US government, is actually rated AA plus, it is not rated AAA. And so that's why you're seeing so much be in the AA plus category. So ostensibly, Microsoft is higher rated than the US government, but that's just an aside. So when we get into the actual account that we're managing for you, if you remember what we had invested last quarter, you may notice that there's quite a bit more invested now, $35 million in total. There's a few things I want to point out here. First of all, the sector allocation in the top left-hand corner remains quite diversified. You can see we have a lot of treasuries, those are in gray. The yellow portion is commercial paper, that is short-term credit. So think of a Microsoft, for instance. Microsoft might issue short-term debt in that 0 to 9 month space. That is something that we might purchase on behalf of the city, and we do have commercial paper in the portfolio. The two blue sections are agencies, so regular Fannie Mae, Freddie Mac, those types of agencies, and also mortgage-backed securities as well, backed by those agencies that are ostensibly backed by the US government. And the green, again, is supranationals. These are things like the World Bank, and they're all AAA rated. So if you look at the left-hand side again, portfolio effective duration of 2.12 years, that is a measure of interest rate risk. So how sensitive is your portfolio to interest rate risk? The benchmark effective duration is quite different. You'll notice it's at 1.31. That's because when this was put together, we were still using the old benchmark. We are transitioning to a new benchmark, which is instead of the 0 to 3, the 0 to 5 year treasury. And so when we see the next quarter's report, you'll notice that there's it's much more in line because of that. And along those same lines, if you look at the duration distribution in the bottom right, you can see that the benchmark only has buckets in the 0 to 1, 1 to 2, and 2 to 3 year space, whereas you're invested now all the way out to the 5 year area of the curve. And again, we usually take about a quarter to get everything kind of in order and organized and restructured in the portfolio. And now we're going to be reporting on the 0 to 5 year treasury benchmark.
Through the chair, is that a normal practice that you guys do?
Yes.
Oh, okay,
Yes.
okay, thanks.
Yeah, so we actually had a conversation, Stacy and I we had been talking about this for quite some time actually, but we had a few different conversations about how we wanted to make sure that, again, we were mitigating some of that interest rate risk of those rates coming down. And so one of the ways to do that was to put the portfolio out a little bit longer. So there was some money that was basically determined to not be needed anytime soon that was put into this portfolio. And we were able to invest those new monies into longer term securities.
Okay. So if something changes, you can go back and forth. We can go back to 3 years
Sure.
if necessary. It just depends.
Absolutely,
Okay.
we could do that, yep.
Okay, thank you.
And it's all about, your risk and your return dynamics, right? What your risk tolerances are, your return objectives, all of those types of things. So those are the conversations that Stacy and I have been having.
Gotcha, thank you.
Issuer diversification just gives you a sense of all the different names that are in the portfolio. On this page, you can really see the difference between March and June. If you look at the bottom there, you can see that there was a big brown section in the portfolio in March. That was a portion that was in the local government investment pool, GovMIC. That money has now been invested into treasuries. So you can see there's a large portion now in treasuries, that gray bar, as of June of 2024. We invest in treasuries basically as the base case option, and then as we see other opportunities present themselves, we will go and purchase those other securities. So you will see that as we look at this upcoming quarter, you're not going to see the exact same sector allocation that we saw this quarter. But basically, we got into the market somewhere in that 430 to 460 range, so really great yields, especially considering where yields are now. Basically 1% higher than where they are available now, and we were able to get that money to work. This shows those trades. Again, a lot in the treasury space, a little bit in agency CMBS. Those are a portion of, they're a slice of the mortgage-backed security index. Basically, they are commercial mortgage-backed securities. We are not investing in retail space, we're not investing in office space, we are investing specifically in apartment complexes and other multifamily structures like that that don't have the same issues that potentially office space or retail space may have right now. Not having the same challenges that those areas are having. We also purchased some commercial paper, so as commercial paper rolled off, again, that's short-term credit, we reinvested into some more. So here's the exciting stuff. Portfolio performance for the quarter. If you look at the past 3 months, interest earned, that's the amount of coupons you had coming into the portfolio, about $260,000. Change in market value, that's based on where rates went. That was about $116,000. So for the quarter, $375,000 in overall interest earnings. If you look at the benchmark and the portfolio return at the bottom, that equates to a 108 versus a 105. That is outperformance, but again, we are switching to a new benchmark, so I don't think that that is a very meaningful number right now. The 108 is meaningful, but I don't think comparing it to a 105 is very meaningful. So anyway, we still saw outperformance, but as you look back over time, you can see that that outperformance has been even more exaggerated. So going back over the past year, you've earned $1.3 million in total dollar returns. That's a 5% return in this portfolio versus the 481 of the benchmark, so handily outperforming the benchmark by 21 basis points. And then if we go all the way over to the right-hand side there, 10 years, you can see similar outperformance, not at the same level of 5%, of course, but still very strong outperformance of about $3.3 million in total return dollars. I'm going to skip over this page as well. This is another thing that a lot of people like to look at, which is accrual basis earnings. So this takes into account any realized gains or losses made from trades, but it also takes into account change in amortized costs. So you see that same interest earned at the top there of $259,000, slight amount of losses based on trades that we had done, because as we're trading out of lower yielding securities into higher yielding securities, we may realize losses. And then you can see the total change in amortized cost was about $108,000. So total earnings for the past 3 months are about $357,000. Over the past 10 years, all the way on the right-hand side, $3.5 million. So again, we're hope you are excited about this. We continue to see that earnings portion continue to tick up at a pretty rapid clip, and that is because interest rates are so much higher than they had been for the past 15 years. Now again, rates are coming down, but we don't expect them to fall off a cliff, right? We don't expect that the Fed's going to start cutting rates by 200 basis points a pop or 300 basis points a pop. So we expect that we're going to continue to see some pretty strong interest earnings over the next couple of years, hopefully the next 5 years now that we've invested out to that 5-year space. The rest of this is just transactions, issuer distributions, and some other things that I've already pretty much covered. But does anyone have any other questions for me?
Any questions from council? No questions from council.
Okay, great. Thank you so much.
Thank you.
Thank you so very much.
All right, so number 4 is public comment.
Are there any comments from the audience? Now we'll close that part out.
Thank you, Mr. Chair. Number 5 is adjournment. The time is 6:54.
So moved.
Support.
The motion by Mr. Wadsworth, supported by Ms. Roscoe for adjournment. Mr. Wadsworth?
Yes.
Ms. Roscoe?
Yes.
Ms. Abdo?
Yes.
Ms. Talley?
Yes,
Chair votes yes. We adjourn. Thank you.
thank you again.
Thank you. Next meeting, 7.
You're pretty noisy there, aren't you? I thought I was bad. With my phone going off.
Sorry about that. 7 o'clock is